So folks, in this session what we're going to look at is some of the more recent standards that have been produced by the ASB, called them something else there, and the reasons behind them and the potential impact that they could have on the exams. So if we start off with the wonderful world of IFRS 10, and this deals with the issue of control and power. It's not what the standard is necessarily called. So the reason why this standard was introduced, it was due to the issues of off-statement of position, of financial position finance, which you might see referred to elsewhere as off-balance sheet finance. And a lot of the reasons why we've introduced new standards is to stop companies from abusing the existing rules in order to manipulate key ratios such as gearing. And this is a classic example. So prior to IFRS 10, some companies, they set up subsidiaries, except they didn't call them subsidiaries, they called them special purpose vehicles or structured entities, and they almost inevitably had huge liabilities. But because they weren't being classified as subsidiaries, all of those liabilities were kept off the balance sheet. So the benefits of the relationship were we have off-balance sheet finance, gearing was kept artificially low because it didn't seem to exist in terms of debt. We seem to have far less debt, and the benefits of having low gearing is that you can borrow more and you can borrow at cheaper rates. So you've got a cash saving and you've got greater debt capacity, both of which are very useful to companies. So what we're going to do under IFRS 10 is that we're going to take a principles-based approach. Rather than having strict rules, we're going to look at some broad principles. And we say, first of all, does the investor have power? And it says the right to direct the other company. So can the investor control the main decisions made by the investment? And what are the main decisions we make in business? Well, they're things like pricing and output decisions. How much are we going to sell? At what price are we going to sell it? Where are we going to make it? How are we going to fund it? So if the investor has the ability to direct those decisions, then we say it has power. Now, secondly, is the investor entitled to variable returns from the other company? These are usually in the form of dividends. But they could reclassify the dividends as interest, and we could reclassify it as some form of share buyback or repayment of some facility. And can the investor use its power to vary those returns? So we're effectively saying here, can the investor dictate the dividend policy? Of the investment. So if it can increase or decrease dividends by 10 or 20% as it sees fit, then the answer to that question will be yes. So we look at those three issues, and you've got to look at all three together. And if the answer to all of those is yes, then we treat the investment as a subsidiary. It doesn't matter how many shares that we own. We say, well, we control the company, and it's control that matters, not ownership. This is an example of what we refer to as substance over form. So that's our first consideration. Now, doesn't give us a definite answer. So we've got some broad scenarios that we can look at. There's some questions perhaps we should be asking ourselves, and the first question is, well, how many shares do we own? Or how many shares do we control? If this is greater than 50%, we treat the investment as a subsidiary. Now notice it's not just ownership, it's control. So remember the scenarios that we often see in complex groups. A has 80% of B, B has perhaps 70% of C, C might have 55% of D. Well, here B, C and D are all subsidiaries of A. And the reason for that is that A controls a majority of the shares. Because C can tell D what to do, B can tell C what to do, and A can tell B what to do. Therefore, A can tell D what to do at the same time. Next, do we have agreements with other shareholders? These are often related parties or friendly parties. Who agree to vote in line with the investor's wishes. So what we might have here is A, and let's say that A has 30% of B, and we've got Miss X, and Miss X is a director of A, and she owns 40% of B. And Miss X has said, I'm always going to vote in accordance with the wishes of A. So therefore, can you see that between A and Miss X, they control, or rather A controls 70% of the votes, and therefore we would treat B as a subsidiary, and we would have a non-controlling interest, which is 70%, which intuitively seems wrong, but from a practical point of view, it works. Next, does the investor have options? So here we have a sleeping tiger. The scenario that could arise here is, let's say that X has 39% of Y X also has options which, if exercised, would give it a further 25% of Y. So therefore, if it exercised its options, its shareholding would go up to 64%. So you can see what happens here from a practical point of view. X says, I own 39%, so therefore I want to treat it as an associate. The great thing about treating an investment as an associate is that it's a single line, isn't it, in the group statement of financial position, and all of the liabilities of the associate don't appear. So therefore debt doesn't appear, and it's great for gearing. But in this situation, if we exercise our options, and all we have to do is to threaten to exercise, let's say that company Y does something that we don't like. And X says, well, I don't like that very much, and company Y says, well, we don't care, because you don't own a majority of the shares. So company X says, well, in which case, I'm going to exercise my options, and I'm going to take control of the company, and the first thing I do when I take control is I'm going to get rid of you, who have just made the decisions that I don't like. Okay? So therefore, Y is effectively a subsidiary, even though from a legal point of view, it isn't. So we look here beyond. This is all here looking at substance rather than the legal relationship. Now this next one is a bit of a strange one. Is the investment relatively a lot larger than that of other shareholders? So we might own less than 50%, but everybody else owns peanuts. So K owns 40% of L. No other shareholders own more than 1% of L. It would be very difficult for the other shareholders to organize themselves to outvote K. So therefore, K is effectively the parent of L. Even though legally it isn't, because we're being practical, and I really like this standard. It's a very, very practical standard. It's to stop people from being sneaky. Now, we next say, is the investor making the decisions or simply carrying out the decisions? So are we looking at a principal and agent relationship? And we can test for this because principals often have some form of payment to an agent. So what we could have here is we've got C incorporated, and then we've got Mr. W, and Mr. W owns 100% of X incorporated. And C incorporated owns no shares in X, but makes decisions that are carried out by Mr. W, who is paid by C for making decisions. Therefore, we would say that C is the parent of X because it is the principal of Mr. W. So we're looking at these pragmatic, practical tests here. So that's IFRS 10. Next, we come to IFRS 11, joint arrangements. Now, this replaces the old standard, I think it was IAS 31. There used to be 3 types of joint arrangement. We've streamlined that. We now have 2 types of joint arrangement, according to IFRS 11. So what do we mean by a joint arrangement? We've got 2 or more investors control another via a contract and that contract exists between the investors. So I could have A and B, each of whom have 50% of C. So control is shared. However, the shareholdings and profit share do not have to be equal. And we need unanimous consent over investment return decisions. So all parties must agree dividend payments, etc. So do we have a contract between the owners? Do we agree to share control? And do we have to agree 100% on the level of dividend payments? Those are the 3 key things we look for. Now we've got our 2 types of joint arrangement. First of all, we've got a joint operation. And with a joint operation, there is no need to create a separate company. So it could be that we're working together on an asset. E.g., we could have an oil pipeline in the Gulf of Mexico is shared between 3 oil companies. So it could be that we've got Exxon, Shell and BP, and they say, instead of we got all of these oil platforms, we need to get the oil back to shore, we could each have our own oil pipeline, but there's huge construction costs. We're tripling the amount of potential environmental damage. We've got decommissioning costs, which could be very high as well. Or we could simply say between midnight and 8 AM it's used by Exxon, between 8 AM and 4 PM it's used by BP, and the other 8 hours it's used by Shell. So we build it big enough so that it could cope with the capacity, and everyone's a winner, aren't they? We could have companies working together on a contract. So e.g., a construction company and an IT company submit a joint contract for a new hospital. And the hospital is going to have all types of whizzy IT facilities embedded within it. So the construction company doesn't have the IT skills, the IT company doesn't have the construction skills, but together they say, well, the government's put this contract out to tender, we're going to submit a tender, and then we're going to split the profits 80-20 or 60-40 or 50-50 or whatever it's going to be. But together we control how the contract is run. It doesn't have to be done on a 50-50. Now, if this is the case, you must keep your own accounting records, because each party will know these are the costs which I've incurred, and we work out how much profit and so on. It is possible to share assets. It is possible to have joint ownership of the assets, in which case you take it on a proportionate basis, and we'd agree profit according to a formula. So here we have A and B tendering for a contract for a hospital. The contract value is 141 million, and we're going to split the profits 60% to A and 40% to B. And they incur the following costs. So we've got production costs, PPE costs. The client has paid the money to A, and A has paid 30 million to B. So what we would do here is we would say, well, we've got A, B, and a total. Revenue. Costs. What are the costs going to be? The PPE has got a 3-year life, so our depreciation is going to be 60 divided by 3 and 54 divided by 3. So our depreciation will be 20 and 18. So that gives us a total of 38. We've got production costs, and our production costs are 37 and 32, so that's 69. Total revenue is 141, which means that we can work out our profit. 141 less 38 less 69. Our profit works out as 34. We're told in the question that we're going to split profit 60 to A and 40 to B. So 60% works out as 20.4 and 40% works out as 13.6. So therefore we can work backwards, and B, we effectively say that revenue here is going to be the balance. So if I know what my profits are and my costs are, it works out that B can show revenue of 63.6, and for A it can show revenue of 77.4. At the end of 20x2, the client has paid for the contract in full. A has received the 141 million and it has paid 30 million to B. So therefore, at the year end, A owes B, well, B is entitled to revenue of 63.6. It's received 30 from B. So A owes B 33.6. So A will have a payable and B will have a receivable for that sum of money. Okay? And it could be worded in a different way, that they split the revenues 60-40 and then they're responsible for their own costs. What is essential is that you read the question carefully. Could be profits which are split, or it could be revenues that are split, and you're then responsible for your own costs. So that is a joint operation where we've got two people working together. An alternative to a joint operation is where we have a joint venture. Okay, a joint venture is a separate entity, so we normally involve setting up a company. It is rare to have goodwill in relation to a joint venture, because when you are effectively acquiring it, it hasn't existed, so it has no reputation. Think about what goodwill is. Goodwill is the brand value, it's the reputation, it's the customer list. Well, if we've just set up the company, it has none of those, so therefore there's no concept as such as goodwill in relation to a joint venture. The investor is entitled to the rights to the net assets, i.e. the profits generated by the JV, but not the individual assets. Now, under the old rules, under IAS 31, you were allowed a choice of treatment in relation to joint ventures. You had a choice of either something called proportional consolidation or equity accounting. Under the new rules, you can only use equity accounting. Okay, so this is exactly the same method we would use as for an associate. This brings IFRS in line with US GAAP. The benefits of equity accounting are that, firstly, the debts of the joint venture are not shown in the group SFP. That's good for gearing. And secondly, the revenue of the joint venture is not shown in the group statement of profit and loss, but the profits are shown. And that's good for your profit margins, isn't it? Because what do you do with an associate? You simply show share of profit of associate as a single line item. So if you're working out your pre-tax profit margin, the profit's gone into the calculation, but the revenue hasn't. So that's going to boost your profit margins. Not your gross profit margin, that won't be affected, but some of your net profit margin is impacted. So that's joint ventures, that's IFRS 11. IFRS 12 is very, 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 very boring, so I'm not going to do anything about it. It's just to do with disclosures. So I'm going to skip IFRS 12. Yeah, I've skipped it so well that I've not written any notes about it. Next, IFRS 13, which is all about fair values. Now we're using fair values more and more in financial statements. Think about the number of things that we do in relation to fair values in terms of calculating goodwill, the way that we measure financial assets, the way that we work out our pensions, where the pension assets are measured at fair value. So there's a lot of figures that have to be adjusted to fair value in the accounts. But what do we mean by fair values? Well, the first thing we say is that we need fair values because the alternative is to use the historic cost approach. We say, well, how much did an asset cost us? Cost figures are often out of date and therefore do not help us in terms of decision making. We then come to fair values in existing standards, but those definitions are inconsistent. Different teams worked on different standards, and therefore they reach different conclusions as to what we mean by a fair value. And actually coming to a conclusion as to what we mean by a fair value proved to be a really tough job. It took them about 5.5 years to agree the standard. It went through so many iterations and checks and rechecks and so on. Lots of committee meetings, lots of business lunches were required. So, let's start off with basics. What exactly is fair value? Well, it's the amount that we're going to get from either selling an asset or transferring a liability to another party. It's the amount that we should receive from selling an asset or transferring a liability. But we've then got a problem because not all assets are the same. There's only one Lionel Messi in football. So how much is he worth? What's the fair value for Cristiano Ronaldo? Very, very difficult to work out. So what we're going to say is, well, let's look at some assets for which we do know the value fairly well. So if we took a barrel of oil, what's the good thing about a barrel of oil is that there's lots of them being sold each day. So therefore we can work out the price on today's date of a single barrel of oil. So we have this thing called an active market, and an active market is one where we've got enough transactions in terms of frequency, so that's how often they're taking place, and the volume is the size of the market to provide pricing information. For example, a listed stock exchange commodities, oil, steel, wheat, lots of transactions every day. Currencies, many retail products also have a fair value. There's lots of them taking place each day. So if we took the look, if we tried to say, well, what's the fair value of an iPhone? Does it have an active market? Well, yes, it does. You know, there's a large number of buyers and sellers each day. Next, we come to a principal market. Now, a principal market is the largest market in which an asset or liability is traded. E.g., a company may have its shares traded in London, 60%, New York, 30%, and Frankfurt, 10%. Now, in theory, the share prices should be identical, but there might be very, very slight differences. Or you might have an island where you've got farmers selling tomatoes in 3 markets dotted around the island, and the prices are slightly different. So which do we say is the fair value? Here, London is the principal market, because it's the largest. It's where the greatest number of transactions are taking place. So how do we go about valuing assets at fair value? Because not all markets are equal. And what we do is that we identify, under IFRS 13, we identify 3 types of market which exist. We've got a level 1 market, and this is the one which is ideal to determine a fair value. It's where we've got quoted market prices exist for identical assets and liabilities in an active market. E.g., shares in Apple. Apple has 3 billion shares in issue. Do you care which, you want to buy 10 shares, do you care which of the 10 shares that you have? That you just own 10 shares in Apple, don't you? You don't care as an individual investor which of those shares that you have. It could be wheat. You know, you buy wheat by the bushel. Do you care whether you have bushel number 1 or bushel number 2? Well, they're all from the same farm. They're identical assets being traded in an active market. currency. If you're looking at, say, the euro to the dollar exchange rate, and you want to buy with your euros $200, well, you don't care whether it's those 20 $10 notes or those 20 $10 notes. They're just $200, aren't they? So the asset or liability is identical, and we don't care as consumers or prospective buyers which of them we're buying. So that is our level 1 market. Level 2 is not quite as perfect. There's certain imperfections. So we're looking at a quoted price for a similar asset in an active market. So we want to buy a 3-year-old Mercedes CLK with approximately 35,000 miles on the clock. So how do you know what's the fair value? Well, what would you do? You would look to see similar transactions for Mercedes of about the same age and about the same mileage. So it's not going to be identical. It might be a slightly different colour. It might have 36,000 miles on the clock instead of 35. It might have 32. It might be 3.5 years old instead of 3. But we're getting a broad picture. So we look to see the price of similar cars of a roughly similar age. So that's one thing we could do, or we find the price for an identical asset in a market that is not active. E.g., we want to buy 1,000 shares in a company who is not listed on the stock exchange. So there's not frequent transactions taking place. 2 weeks ago, there was a sale of 1,000 shares at $47 each. Now, in that 2 weeks, the company's prospects may have gone up or they may have gone down, but the fairest value that we can come up with, well, the most recent one was $47. So that would be our start point for determining a fair value. Or you could be looking to buy an apartment, and the construction company has made 8 apartments and they're all identical. And we don't know how much to pay for them, but there was one sold 3 months ago and that one went for $350,000. So it's not an active market. We're not selling lots of the apartments or lots of the shares on a daily basis, but we've got some transactions, and that's a start point for determining our fair value. We've then got observable inputs for things such as interest rates and credit spreads. These would be used when calculating the fair value of bonds which are not being traded on an active market. So we might have some private bonds and we know what's happened to interest rates, so we can work out if it's a 6% nominal bond, we'd say, well, let's take a look at a company of a similar risk, what's happened to interest rates movement since they were last quoted, and that gives us a position. So our level 2 markets are not perfect, but they're not rubbish either. We then come to a level 3 market. And here we're sort of entering the realms of guesswork. We use unobservable inputs. So we might say we've got a property and it's a unique property, or it's a piece of art. What do we think it's worth? Very difficult to gauge. So we'd look at perhaps the cash flows or management judgment, e.g. a football club want to buy a star player, okay, a star goal scorer. They use management judgment to calculate a £30 million or $30 million price. But that management judgment is the opinion of 1 person, 2 person, 5 persons. It's the least reliable. So those are our 3 types of market that we have in respect of trying to work out the value of an asset or the transfer fee of a liability. Now, when we're measuring fair value, we should take into consideration the highest and the best use of an asset. This may involve ignoring the current use of the asset. E.g., a company owns property that it rents to commercial customers for $600,000 a year. It could rent the property to domestic customers for $750,000 a year. So its current use is not necessarily the best use. And for whatever reason, you know, it decides that it's going to carry on using it to its commercial customers because of its relationship with them, could be tied into a deal. You just don't know. In theory. We should take into account the principal market in which the asset is traded. even if the asset itself is not part or has not been purchased from that market. So how do we go about valuing our assets? Well, we can look at the broad principles. We can take a market-based approach where we say, well, what is the value of a can of beans? You know, a can of beans is a can of beans, isn't it? And I'd pay, if everybody else is paying $1.20 for it, it's worth $1.20. So at what price are identical assets being traded? So if iPhone 6s are currently on sale for $800 each, I can't claim that mine's worth $1,200 because identical assets are being traded in active markets at a different price. We can have a cost approach. Now, the cost approach, we should use replacement cost rather than historic cost. And when we talk about the replacement cost of an asset, it should be in the same condition and age. So if I own a 3-year-old Mercedes and I'm looking at the replacement cost, I'd say, well, how much would a 3-year-old Mercedes cost me? Not how much would a brand new Mercedes cost me. And then finally, we've got an income approach. And remember, this is used when we're doing impairment calculations. We say, well, what's the present value of the cash flows generated by an asset? But we've got problems here. Of predicting future cash flows. Can be quite difficult. But if you look to see what investment banks do when they are trying to value a company, think about what happened when Facebook acquired Instagram. It said, well, how are we going to come up with a fair value for the shares of Instagram? The way that it did that is it tried to work out the present value of the cash flows generated through Instagram's apps and customer loyalty and things of that nature. And then added a few zeros. In terms of the restrictions, the main restriction, we can only use our IFRS 13 rules if we're allowed to use fair values by another standard. For example, we cannot apply IFRS 13 to inventories because they are measured at the lower of cost and NRV. Nowhere in IS2 does it say measure inventories at fair value. So if the standard says you can't use it, then you can't parachute IFRS 13 into the scenario. IFRS 14 is quite specialist, so I'm going to skip that. And we now come to IFRS 15 on revenue. this replaces IAS 18. I think this is quite a high-risk topic. I would expect to see this examined in the next, somewhere in the course of the next 2 to 3 exams. Whether it's this one or the next one, I don't know. But this certainly is a high-risk topic. And the examiner has written 2 articles on contracts. So, what do we mean by a contract? Well, it's something which has been agreed between 2 parties. They're committed to performing obligations, but not all of the obligations. E.g., we might have a contract to deliver somewhere between 10 to 15. We've got a customer, and the customer says, I want to try out your machines. I'm going to use between 10 and 15 of them. So provided we deliver a minimum of 10, then we've committed ourselves and we've agreed to the contract. We don't have to deliver all 15. It could be that we don't like the customer or the customer doesn't like us. So you must perform your obligations, but you don't have to do everything, because some contracts contain an element of flexibility within them. The rights and the terms are agreed. This is not the same as agreeing a price. E.g., let's say that we've got a contract to build a school at cost plus 20%. So the contract says that we can put into the contract some profit margin. And these are quite dangerous contracts, but sometimes, especially for government contracts which involve an element of risk, you won't get the other party signing up, because they'll say, well, we don't know how much it's going to cost us, so therefore we can't agree a price. If you think about a legal, if you've got a legal case, what the lawyer will say is, I'm going to charge you, knowing a lawyer, $1,000 an hour for as long as the case might be over in a day, or it might be over in 2 weeks. I don't know. So I'm not going to agree a fee. I'm just going to agree the rights and the terms. And the terms are $1,000 an hour plus expenses, plus sales tax, plus commission. The contract must have commercial substance, so we look beyond the legal form. Okay, we ignore the legal arrangement, and it's probable that revenue must be collected, so we are confident that we will be paid. Now, in IFRS 15, we have something called the 5-step model, and I do think it's important that you familiarize yourself with the 5-step model. So the first thing we do is we simply say, well, do we have a contract? Do we have 2 parties who have got some obligations towards each other? And that can be very, very simple. I've just ordered a car, and the contract says I agree to pay the car dealership, and they agree to supply me with a car. Simple contract, isn't it? But we've identified that as the first stage. Next, we identify the obligations, and we should always try to unbundle the elements. E.g., a car sale may include a 3-year warranty deal. So we've agreed to pay $40,000 for a car, and included in that is a 3-year warranty transaction. Or we've agreed to buy some computer equipment, and that includes 3 years maintenance and servicing by the computer company. We've got to do is that we've got to separate out the elements from the contract, because not all of the contract elements are taking place or are being performed at the same time. Okay, so we have a separate obligation if the customer can benefit from the good or the service on its own. Think about the car sale. I could buy the car without the warranty, or I could buy the warranty without the car. Or you could buy them together at a bundled price, because we'll look at the issue and prices in due course. If we've got identical things being sold and identical services, you can combine those. So if I've got selling 6 identical cars and 6 identical warranties in the same contract. So let's say that you go and you're buying on a corporate basis 10 computers. You don't have to separate that out into 10 separate contracts of 1 computer each. So we buy 10 computers. This does not have to be treated as 10 separate contracts. And let's assume all those contracts are for MacBook Pros, 13-inch, what's-it-call-it, and so on. So we identify the contract, we work out our obligations, and next we work out our price. So the price is the amount we expect to receive in exchange for providing goods and services, and that excludes things such as sales taxes, e.g. we sell a television for $1,200, including a 20% sales tax. The price is 1,200 times 100 over 120. So the price, as far as we're concerned, is $1,000. Now, the problem with some prices is that they vary according to how much is being bought and sold. And here we use a probability-weighted approach. So I've got an example. I've got this company called Barber, and it's selling beans. Okay, not a very exciting product. But we've agreed to sell beans, but the price decreases if Dodger buys more beans. So it's going to vary from $2 to $1.80 to $1.50, depending upon the number of beans being sold. Now, at the 1st of January, we don't know how many beans we're going to sell. So we get to the end of January, and we've sold 28,000. That still doesn't know. I still don't know whether I'm going to sell 300,000, 300,000 to 400,000, or 400,000. It's simple guesswork. So what we do as managers, we try to work out an estimate. So what have we got here? We've sold 28,000 beans, and there's a 20% chance of selling less than 300,000, so there's a 20% chance of receiving $2. There's a 50% chance of selling 3 to 400,000. So that's a price of $1.80. And there's a 30% probability of it being $1.50. So 2 times 0.2 plus 1.8 times 5 plus 1.5 times 0.3. That doesn't work. So 2 times 0.2 plus 1.8 times 0.5 plus 1.5 times 0.3. And that means our probability weighted price is $1.75 per can. So we work out our price for the month as being $49,000. Now, as those probabilities change, so will all the totals. But it's something that will arise over the course of the year. We should take into account bonuses, penalties, things of that nature, and those can be quite important in long-term contracts. If let's say we've signed a contract to build a hospital and it has to be completed by the 31st of December, and we don't do it until next March, and we have to pay a 25% penalty. So therefore that's going to affect the price. And we should also take into account financing elements. So here, Knight is selling a machine to Perry for $800,000. We'd normally expect to be paid within 30 days, but what we've done is that we've said to Perry, you can pay us in 2 years' time. So here we're looking at the impact of financial assets and financial transactions. What would we do here? Well, on the 1st of the 1st X1, we would credit revenue with 800,000, but I'm going to discount that for 2 years at 12%. So go credit revenue 638, debit receivables 638. At the 31st of December X5, we recognise finance income. So here I'm going to credit investment income or finance income or whatever you want to call it, and that's going to be 638,000, and we're receiving finance income at the rate of 12% a year. So that's 77,000, and we would debit receivables. So that should be investment income. Debit receivables 77,000. Sorry, X1. X1, I don't know why I did X1. And we do exactly the same in X2. Then we allocate the price to the obligations. And I'm going to combine steps 4 and 5. And we should allocate discounts on a proportionate basis to each element of the obligation. So step 4 is our allocation. And finally, step 5, we recognize the revenue as we deliver. Now there's two things that we can deliver. We can deliver goods, and with goods, it's where the ownership, risks and rewards are transferred to the customer. So I've just ordered my car. When can the car dealership, and I've paid a deposit on my car, when can the car dealership recognise the revenue? I paid a 25% deposit. Can they recognise all of the revenue, 25% of the revenue now? No. Because they might crash the car might fall off the production line. Something might happen to it before they transfer the risks and rewards. The day I go into the car showroom, say, wow, that looks fantastic, drive out of the car showroom and straight into a bus, it's my problem, it's no longer their problem. So for goods, this is usually on delivery. For services, it's usually on a time basis. E.g., if we have a service contract or something such as a magazine subscription, or you might have a phone contract. So if you get a phone contract, you might get a phone contract for 2 years. So what will happen is that the phone company will recognise the revenue over the course of that 2-year period in respect of the amounts of money you've agreed to pay. So we treat goods and services in a different approach. So let's take a look at a scenario. So we've got a company called Holt. I've got no idea where I got the name for that company from. And it sells satellites, TV boxes, and channel subscriptions. So we normally sell the box for $5.60 and the subscription for $60, but we can sign up for a 2-year deal. So the 2-year deal a 2-year contract without the deal how much would that be? That would be $560 for the box plus 24 months at $60. That gives us a grand total of $2,000. If we sign up for the 2-year deal, it's 24 months at $62.50. So we're going to save ourselves $500 or 25%. So therefore the discount for the deal is 500 over 2,000 is 25%. We apply the discount to the box. So that's going to be, how much is it normally? It's going to be $560 minus 25% of $560. So the box is $420, and then we've got the monthly rental and we would normally pay $60 a month less 25% of 60. So if we get somebody to sign up for the deal and we've bundled the whole things together, we've got to then separate it out on a percentage basis. So it says, how should Holt account for a 2-year contract signed with a customer on the 1st of April X1? So on the 1st of April X1, we've got revenue from the box is 420, and from the 1st of April X1 to the 31st of December X1, we've got revenue from rental 9 months at $45 a month works out as $405. Therefore, what am I going to do? I'm going to debit cash. I've received 9 months worth of income. Under the deal price, the customer pays me $62.50 a month. I'm going to credit revenue 420 plus 405. So I'm going to credit revenue 825 and accrued income with the balance of 262.50. So do we have a contract? Yes, we do. Do we have performance obligations? Yes, we do. Allocate, unbundle, identify, and go through your steps. So that is IFRS 15.